anybody can learn trading with this approach. So I'm not just sharing the story about how I learned how to trade with you, but I'm going to be showing you the step-by-step ways I use to learn how to trade. Good day, everybody. I am so excited for this video today. If I just see me for the first time, hi and welcome to this channel. This is a trading channel and my name is Precious. So I'm not making this video just to share my story about how I learned how to trade, but I'm making this video to rekindle somebody's hope. Like somebody that just feel like, oh, the trading is very tedious and learning trading is not for them and trading is difficult to learn. I'm going to be showing you and sharing with you in this video the step-by-step approach I use in learning trading. So you can know that, okay, maybe the approach that I've used for you or you're using to learn, it's not favorable. So the first thing I was introduced to in trading was blockchain and cryptocurrency. So the blockchain where you get to know about native coins and blockchain when you know, okay, and multiple network of computers, and it was very interesting. You get to know about decentralized wallet and centralized wallet, where decentralized wallet is where you put your address and your name, your government identity and all of that. Then it decentralized is not governed by government, it's not controlled by government. And very interesting to learn. So that was the first thing I was introduced to in trading. So the second thing was how to take a trade on Bybit. So I used Bybit to trade crypto, which like very interesting, right? So when I was introduced to Bybit, they taught me about risk management. And that was when I got to know how to calculate position sizing, where a risk amount divided by the stop loss percentage. So I got to learn about that, or how risk management is very important, and how to take trade on Bybit, how to long, buy, sell, shorts, how to break even on Bybit, and all of these interesting things. So the third thing I learned is on chart pattern. You know that chart pattern that you have head, shoulder, inverse, and all of these things, engulfing candle, you know, a lot of chart patterns. I was taught how to identify them in the market, how to know, okay, if you have double top, double bottom. So if you have double bottom, it's like a double bottom is this W shape like this. You know that the market is trying to change character, is going bullish. If you have this double top, you know that, okay, the market is trying to be bearish. So you can follow the step now. We're taught blockchain, from blockchain how to take a trade, and then how to identify charts in the market. So these are the steps. The first step was on market structure. So I taught market structure for the very first time in my life. I was taught that we have three types of market structure. We have bullish market, we have bearish market, and then we have ranging or consolidating market. We are taught the characteristic of bullish market, bearish market, and ranging market, where you know that, okay, in a bullish market, you have break of structure to the top side, to the upside, and also in the bullish market, the structure creates higher high and higher low. In a bullish market, the impulse is bullish, where the pullback is bearish. You know, we have like when the market is going this way, it's bullish, and also the characteristic of a bearish market, where you get to know, or you have break of structure to the downside, impulse is bearish, while the pullback is bullish. You know, it's a bearish market. And also the structure in the bearish markets creates your lower low and then your lower high. They've taught all of these. And then the ranging markets, you get to know that, okay, there's no break of structure in the ranging market. The pullback and the impulse, the movement, the impulse and the pullback, they are equal. There is no creation of higher high, higher low, or lower low, and lower high in a ranging market. So like price is just consolidating. So there is no specific direction of price. Price is moving sideways, you know. So like very interesting. So that was the step I used to learn trading. Also be eager to know what will happen next, because after learning, okay, this is a bearish market, this is a bullish market. Okay, what next? You know, okay, how will I take a trade now in a bullish market. So you'll be asking questions like that with this kind of approach. The fifth approach is where the technical analysis comes in, where we're taught we have internal structures and then we have external structures, and also how important it takes to do multiple time frame analysis from the higher time frame to the lower time frame, and how to identify internal structure to 30 minutes, 15 minutes, 5 minutes, and how to identify external structures in the markets. So which is very important, because now you have learned, okay, we have bearish, bullish, ranging market. Now you are learning that, okay, even in this market, we have internal structures and then we have external structures. And now, like, you can identify your external structures when you go to the higher time frame, and you can identify your internal structures when you go to the lower time frame. So you get to know that, okay, if I'm in 30 minutes time frame, if I'm in 15 minutes, 5 minute time frame, I know that any break or structure I'm marking there, they are my internal break or structures. And if I'm in 1 hour, 4 hours, like daily time frame, any structure I'm marking there, they are my external structures. Then, like, after being taught how to even identify bearish market, bullish market, and how we got to know that bullish market creates higher high and lower high in the market, and bearish market create lower low and lower high in the market. The next step was how to identify this higher high and higher low and lower low in the markets. Because if you don't know how to identify these things, there's no way you'll be able to identify break of structure in the market, where you get to know that, okay, in a bullish market, you have break of structure to the upside, and your break of structure is the distance from your higher high and the low of the high. And then we got to know that, okay, in a bearish market, we have our break of structure to the downside, because our break of structure in a bearish market is the distance from our lower low to the high of that low. So now you, like, bringing it together, it's making a lot of sense now. We taught structures before introducing technical analysis. So now technical analysis was introduced, and then the first thing was how to identify your higher high and then your lower high in the market. After that, now the next thing is the break of structure, which is very important. Also, the characteristics of break of structures, the importance of break of structures, that break of structures create opportunity in the market. Break of structure enables you to know that, okay, this market is going bullish, this market is going bearish, which is very important to know the movement of price in the market, so you can know how to take a trade accurately. The next thing was on order block. So now, order block in a bullish market as well as order block in a bearish market. Okay, which is very interesting, right? And then it's kind of a little confusing, but anyway, it's very easy with this step-by-step approach. You get to learn everything and you'll be excited to learn how to trade. So order block in a bullish market is on, after your break of structure. Now you know how to identify your break of structure. Now is your order block. After your break of structure, the last bearish candle is your order block in a bullish market. And in a bearish market now, when you must identify your break of structure to the downside, your last bullish candle after your break of structure is your order block in a bearish market. And you can see, because now you'll be anticipating. Now you'll be like, okay, now I can identify my break of structure, I identify my order block. So what next? You keep asking that question, what next? Then the next thing is your confluences. So confluences are very important in taking a trade. So when I was learning how to trade, these are the step-by-step approach I use to learn how to trade. So the confluences, you get to know about fair value gap and also your imbalance and your liquidity. So now I know how to identify your break of structure, I know how to identify your order block. The next thing now is your confluences. Which one of your confluences now is your fair value gap. Okay, how do you identify your fair value gap? Now your fair value gap is the space between 3 consecutive candles after your order block. You see how interesting these things are, right? They follow each other in a sequence, so you have to learn this one before you learn this one. If you don't and you're jumping, you're missing it, it will confuse you, and that is why you're feeling like trading is difficult to learn and it's tedious and you can't and you're already trying to give up. Please don't. So this video is just created to help you understand that trading is not, if you are following this step-by-step approach to learn how to trade. So your fair value gap is the small space between 3 consecutive candles after your order block. So now in the bullish market, now you find your order block. The next thing is to look for the space between 3 consecutive candles after your order block. So if there is no space between your 3 consecutive candles after your order block, there's no point taking that trade, you understand, because that is not a valid order block. So now you're getting the point. So your imbalance now is a larger space between 3 consecutive candles after your order block, which imbalances are created by impulsive movement of price in the market. The purpose for fair value gap and imbalance is the guarantee that price is going to come down there, fill the space and tap your order block. That is the purpose of fair value gap and imbalance. So imbalance now, there are impulsive movement of price in the market. There will be correction in the market and price have to come to fill the imbalance and tap your order block and then start going in your direction. So that is how it works. So for your liquidity, so liquidity is very important. Liquidity is where price fail to tap an order block. So liquidity in the bearish market and also liquidity in the bullish market. So these are the things that you need to look at for when taking a trade, After you must identify your break of structure, the other things, your order block, your fair value gap, your imbalance, your liquidity. So you guys, I entered this trade yesterday, BTC. I even posted it in my community, right? So there wasn't enough liquidity when I entered the trade. And let me even look at it here. So like the market has been trying to form liquidity since, and you can see it almost took me out. Liquidity, very, very important. You must identify liquidity before taking a trade. Because markets like try to form liquidity before going, enough liquidity before going in your direction. The next thing I was taught was risk management. Like risk management is extremely important. Like all the sniper entries, we have sniper entry to poverty too, and it's real. It's very, very real. And the reason why most people lose money and go broke, blow accounts and all of that is mainly because of improper risk management. So each time I'm always shouting, use proper risk management. Don't risk more than you can handle. Don't even dare risk more than you can handle. So risk the amount you know that you'll be comfortable with when it doesn't go your way. So risk management is very important. And I know most people will be like, then why even taking the risk? Life is a risk itself. Like faith is risk. So what is the guarantee that that business you are doing is going to be successful? You have to take the step, you have to risk it, you have to take the bold step, which is risk. Just take calculated risk, be calculative with your risk, always do proper risk management. And also the next thing, the most important part that will break you or make you in trading is the psychology of trading, the emotional perspective of trading. So I was taught not to be trading, over trading, the fear of leaving money on the table, the fear of missing out, trading news, NFP when you are not a pro yet, it's crazy. So like psychology of trading is very important. And also I was also taught fundamentals, how to interpret fundamentals, So that is very important. And when I started trading, I was kind of using fundamentals to trade, but I wasn't a pro then, so I won't say it was beneficial, but you see, like I'm just telling you the steps I used to learn how to trade. And on the next thing, Fibonacci. So I was taught Fibonacci as well, but I am using smart money concepts. So Fibonacci too is very important. So I was taught that as well. These are the approach I used to learn how to trade. You can see they are step by step, they're in sequence, they're well arranged. you too, you'll be anticipating, you'll be eager to know what's next, what to do next, not like you'll be frustrated and sad. No one out there is going to be teaching you other block when you don't even understand the direction that price goes in the market yet. Of course, you get frustrated. So, step by step. Okay? So thank you for watching to the end, and I hope this video is beneficial to you. I'll see you in my next video.